Hello, and welcome back to the channel. My name is Zach Collins, and this is Financial Education. Today, what we're going to be diving into is something I find quite interesting. Most people hate it, but it's something that everyone needs to deal with, and I thought, why not explore? And that is the basics of tax. Now, the first myth I need to dispel before we go any further is around tax brackets. I see all the time people talking online about how they don't want to increase their income, don't want to go over a certain amount because it'll change the tax bracket they're in. That's not a thing. In Australia, we have a progressive tax system, and I'll show it to you now. If you earn between $0 and $18,200 in the financial year, this is between the 1st of July and the 30th of June, you'll pay no tax. If you've had tax taken out of your pay throughout the year, when you lodge your tax return, you'll get all that tax back. If you earn anywhere up to $45,000, you'll pay 19 cents in tax for every dollar that you earn of $18,200. This means that if you earn $45,000, you pay a total tax of $5,092. I haven't included the Medicare levy in here yet. I'll get to that in a bit, but this is just pure income tax of $5,092. If you were to divide that by the total income of $45,000, it's around about 11.32% of your income that you pay in tax. This clearly shows just because you've gone up a tax bracket doesn't mean you're now paying the new marginal rate on all of your income. The next bracket is $45,000 to $200,000. Now, this is taxed at 30%. In this bracket, you'll be paying a maximum tax of $46,500 plus $5,092 from the early tax bracket, brings the total tax on your income of $200,000 at $51,592, which represents a percentage of about 25.8%. Any income you earn over 200 gets taxed at a rate of 45%. The biggest thing that you'll notice if you're paying attention is that each new tax bracket only taxes income above the respective threshold at the new rate. Just because you move up a tax bracket doesn't mean all the income you've earned previously is now taxed at that new rate. On top of the respective tax rates in Australia, we have something called the Medicare levy. If you've never heard of Medicare, this is the government's funded healthcare. We're very lucky here to have free universal healthcare, and there's an income tax levy of about 2%, which pays for that. So what does that mean in practice? If you're in the $18,200 to $45,000 bracket, it means you pay an income tax of 90% plus a 2% levy. Essentially, your marginal tax rate is now 21%. Same for the other brackets. 30% becomes 32, 45 becomes 47. Now, there is a feed-in rate, so low income tax earners don't actually pay the full 2%, but for all intents and purposes, let's just assume it's a flat 2%. Now, these tax brackets are how we calculate the tax that you pay on all the income you earn. Income can be classed in two different ways. So income includes what you earn from your day job. It includes the interest you might earn from keeping cash in a bank account. It includes any rental income if you have a property that you're renting out. It includes any dividend income from shares that you hold, and there's other forms of income too. But these are all the basic ones that you really need to know for now. The other type of income is capital gains. We tax it in a very similar way. The only difference is that you can get a 50% discount on these gains if you've held it for more than 12 months. So how does this actually work? Let's say you bought some shares for 50 grand. If you then sell those shares in less than a year for $100,000, it means you made a capital gain of $50,000. And that's the difference between your sales price and your purchase price. Because you held for less than a year, this $50,000 gets added to your other taxable income. So if you earn $50,000 from day job plus that capital gain, it means the ATO will tax you as though you earned $100,000 throughout that financial year. Let's use that exact same scenario, but instead of selling them in less than a year, now you've held for more than 1 year. So it has to be anything from 1 year and 1 day up to 1 billion years. Like, there is no upper limit. It doesn't make any difference how long you've held it, as long as it's more than 1 year. You're then entitled to a 50% discount on the gains. So you still sell your $100,000 shares, you made a $50,000 gain. Once you apply that discount, it means you're only paying tax as though you've made a profit of $25,000. That's $50,000 times 50%. So this $25,000 gets added to your day job income of $50K. It means you're taxed as though you only earned $75,000 in that financial year. $75,000 puts you, in the 30% tax brackets. This means by waiting to sell until you've held it for more than a year, you've saved about $7,500 in tax. Okay, so now that we've looked at what gets included in your income and tax, is there a way that you can reduce the amount of tax that you need to pay? There is. This is called an allowable deduction. Why did I specify allowable? That's because depending on the job you do and the type of income you make, there's certain deductions you can make, but they're not universally applicable. You got to make sure you check what you're allowed to claim. So what actually is an allowable deduction? An allowable deduction is a cost that you have specifically incurred in order to earn income. What does this mean? If you're in office work, you might incur stuff such as electricity or internet expenses that if you were to work from home. Now, the ATO website has a lot more specific details about what and the amounts that you can claim for work from home deductions. So I really implore that you guys check that out. If you have a rental property, you can claim interest expense on the mortgage of the property. Now, you do need to note that you can't claim the principal portion of the loan, just the interest. You can also claim stuff like the agent fees to manage the property and any repairs and maintenance that you do to that property. If you do an improvement to the property, like a remodel, for example. Now, this is actually a capital expense. You can depreciate it and it comes off your tax, but it does have to be done over a few years. It's done over 10 years instead of the first. There are a few different types of deductions that have actually gone to court. There was one where a lady was an air hostess and she claimed, I think it was her moisturizer as a deduction. This was allowed in her case because the court was able to establish that the air in an airplane is quite dry and harsh, and the moisturizer was required for her role. For the vast majority of people, however, this is not an allowable deduction. More mainstream stuff like clothing is also generally not deductible. Uniforms can be, but it needs to be registered in order for that to be allowed. Stuff like suits when you work in a corporate environment. It's the expectation everyone's wearing a suit, but it's considered conventional clothing. Now, what does this mean? It means that you can wear it wherever you want. I mean, if you're in the military, you're not going to wear your military uniform when you're out of the pub, when you go into a wedding, when you're on holiday, etc. Now, that's a work-only uniform. Suits and business attire can be worn anywhere. You can see I'm wearing one now. This is something you don't only wear for work. This means it is not an allowable deductible expense. Cars and transport is another big contention. You can claim expenses incurred in driving your car for work. Now, you do need to check the ATO website for specific details on how much you can claim, but you can't claim your travel to or from work, just the travel and expenses you incurred for work. An example could be a real estate agent. Say, look, they drive to work in the morning. They then go drive to various houses for open homes or inspection, whatever, and then they drive home. Now, the drive to the office in the morning is not deductible. Neither is the drive home. However, all the costs they incurred driving to the different properties, fuel, wear and tear on the car, any road tolls, stuff like that, would be considered an allowable deduction. There are a ton of other deductions I haven't got into, but that's not what this video is about. I'm just giving you a bit of a brief overview. If you'd like to know more details, let me know and I'll see what I can do on making more details about income and expenses in the future. Look, in saying that, hopefully I've been able to help you give a better understanding of the tax system, how the different tax brackets work, and some basics around different types of income and deductibles. If you have any more questions, feel free to drop a comment below. I'll answer if I can. Thank you so much for watching. I'll see you guys in the next one.